Welcome to Motion and Means, the podcast that connects the dots between transportation and opportunity. I'm your host. Every journey, every route, every mode of transport we rely on isn't just about movement, it's about access. Access to jobs, to education, to community, to a better quality of life. Here on Motion and Means, we explore how transportation acts as a vital enabler, a true economic equalizer that can shape our communities and our individual futures. We'll look at the innovations driving change, the policies that can create more equitable systems, and the human stories behind the infrastructure. So, let's get moving. This is Motion and Means. Today, we're diving deep into the global transportation market, and honestly, it looks pretty chaotic right now. We're seeing signals that seem to contradict each other everywhere you look, but what if, maybe, this chaos is actually hinting at a new kind of predictability, a new future for how things and people move? Our mission today is to sort of unpack the clues hidden in recent data, recent events, and figure out what these complex trends mean for global supply chains and, well, ultimately for you. So let's start with that core puzzle. We've got this persistent, really stubborn freight recession. It's been going on for, over 2 years now?
Yeah, well over 2 years, easily.
But then you see these flashes, these pockets of activity that seem, anomalous, even record-setting in some places. It feels weird, right?
It absolutely does. And it really highlights why maybe our usual yardsticks, our traditional metrics, aren't quite giving us the full picture anymore. I mean, think about it. You've got a major port shouting about record volumes.
Right.
While at the exact same time, a key national freight index marks its 30th straight month of decline.
30 months, wow.
Yeah. And that's not just a blip. It signals something deeper, a fundamental realignment happening in global trade. And, a freight recession like this, it isn't just fewer boxes moving for a bit. It's a sustained, serious drop in volumes, in rates. It creates this painful oversupply of ships, of trucks.
Which forces a correction.
Exactly. It forces a correction. And on top of that, you have these global tensions that are, they're literally redrawing trade maps and reshaping how companies operate.
And a huge part of that reshaping comes down to tariffs and trade policy, doesn't it? They're not just footnotes anymore.
No, not at all. They're core drivers now. They influence, pretty much everything. Container volume, sure, but also insurance premiums, routing decisions.
Yeah.
The works.
It really is a mixed picture, though.
It is.
Because on one hand, you see nearshoring really taking off, like U.S. trade with Mexico.
Oh, yeah, that's booming. It hit, over $73 billion in June alone.
Incredible. So that just underscores how vital that cross-border commerce is becoming, creating opportunities closer to home.
Definitely. But then you have this tariff anxiety, especially around U.S.-China trade.
Yeah.
It just won't go away.
Even with that temporary 90-day pause on a tariff hike.
Right. It seems the market views those Trump-era tariffs as basically the new normal now. They're baked in.
And that anxiety, it actually had a really interesting effect on shipping, didn't it? That record month at the Port of Los Angeles.
Yeah, that was fascinating. Over 1 million TEUs, 20-foot equivalent units in July. First time ever.
So you'd think, great, the economy's bouncing back.
You would, but no. That wasn't about real economic recovery. It was very specifically driven by what the industry calls China volumes, meaning it was a strategic pull forward. Retailers basically rushed imports in, trying to get ahead of potential future tariffs, stocking up, just in case.
Okay, so if it wasn't genuine consumer demand driving that surge, does that mean we've just kicked the can down the road, borrowed from future demand?
And it's precisely the risk, yeah. That artificially inflated demand, it could just poof, disappear. Once the tariff situation clarifies one way or the other,
and then
you could see a really sharp downturn in import volumes. That could actually deepen the freight recession we're already in, hitting future trade, and, importantly, all the jobs tied to logistics, warehousing, trucking.
And beyond just tariffs, there seems to be this broader shift, a real lean towards protectionism, a domestic focus in U.S. trade policy.
Absolutely. You see it in initiatives like Make American Shipbuilding Great Again.
Yeah.
That's part of a new deal with South Korea.
Right, and things like domestic grants, tax breaks for trucking.
Exactly. It feels like a very coordinated government push to, reduce reliance on potentially volatile foreign supply chains.
Yeah.
To build up more U.S. industrial and logistical muscle.
The goal seems pretty clear. Create more opportunity and resilience right here at home.
That's the narrative, yeah.
Speaking of resilience, or maybe the lack of it, something that really seems to be escalating is the geopolitical and security risk factor. That's changing the game for global access, isn't it?
Oh, profoundly. And you're right to flag it. The key thing is how these flashpoints, these incidents, translate directly into costs and risks for commercial shipping.
Like that collision in the South China Sea
hmm
between the Chinese and Philippine vessels near Scarborough Shoal.
Exactly. That's not just a news headline. It's already expected to push war risk insurance premiums up, maybe 12 to 15% a year.
Wow.
And fuel costs could jump 3 to 7% just from ships having to reroute to avoid risky areas.
Yeah.
That hits the bottom line, and it impacts reliability for everyone relying on those trade lanes.
And it's not just one spot, is it? We've seen the Houthis targeting ships linked to Israel, making the Red Sea even riskier.
Right. And then totally new threats pop up, like that narco submarine discovered way out in the South Pacific. That's organized crime moving into completely new territory.
Unprecedented.
It is. And if you connect the dots for shipping companies, it means unexpected delays for more inspections, plus a higher risk of piracy or extortion attempts.
So higher operating costs.
Much higher. And those costs hit the smaller, less capitalized companies the hardest. It really accelerates market consolidation, bigger players buying up struggling ones, which ultimately affects who even has the means to participate in global trade.
Okay, so beyond security threats, we also have these big regulatory shifts happening, particularly around sustainability. The U.S. formally rejecting the IMO's net zero framework for shipping. That seems pretty major.
It is a big deal, yeah.
Yeah.
Because it creates this fragmentation of global climate policy.
Instead of everyone being on the same page.
Exactly. An international industry like shipping, it really thrives on, or at least needs, a uniform global framework to operate efficiently. Without it, you get this regulatory patchwork.
Which means?
Well, it creates uncertainty. It could lead to competitive disadvantages for companies in stricter regions, or maybe even a race to the bottom where companies flock to places with lax rules. It certainly disadvantages those who do invest in decarbonization if others aren't required to.
So a real headwind for hitting those climate goals.
A significant one, especially when you hear the IEA saying transport emissions need to drop over 3% per year to hit net zero by 2050. This lack of a unified approach really pushes the burden onto private innovation to find solutions.
And even domestically, we're grappling with how to fund infrastructure, right? Like the debate about moving from gas taxes to road user charges because of EVs.
Yeah, that highlights the constant challenge. How do we pay for the roads, bridges, ports we need for the future, especially as the way we move changes?
All these big macro forces, they play out really differently depending on the mode of transport, don't they? Creating unique challenges, but also unique opportunities for access.
Let's zoom in on maritime freight first, because that seems like a real tale of two markets right now. Container shipping. Asia-Europe rates are actually going down, even though bookings are apparently robust.
It seems paradoxical, right?
Oh.
But the culprit is just massive overcapacity in container ships.
Too many ships chasing too few goods.
Precisely. That record July at the Port of LA, like we said, a short-term, policy-driven blip, not real demand recovery. Carriers have tried using blank sailings, just canceling scheduled trips to prop up rates.
But it hasn't worked.
It largely hasn't stuck, no. There's just too much excess vessel capacity out there. It shows this isn't just a quick dip, it's a prolonged rebalancing. For container lines, the freight recession is definitely not over. That impacts efficiency all the way down the supply chain.
Okay, but then you flip over to the tanker market. Completely different story, almost booming. Totally different dynamic. What's happening there is that U.S. and EU sanctions are effectively shrinking the shadow fleet. Those tankers operating outside Western rules, often moving sanctioned oil.
So taking non-compliant ships off the board.
Exactly. And removing that illicit capacity creates a real opening, a real opportunity for the legitimate compliant operators. You saw Torm's CEO being very optimistic.
Torm, the Danish tanker company.
Yeah. He explicitly said U.S. sanctions hitting the shadow fleet were good for business. Their stock jumped after they reported solid bookings. It's a clear case where geopolitical actions are tightening the available ship supply, directly benefiting the compliant players.
Okay, let's shift to land. Road and rail freight. Domestic markets seem to be feeling the strain too. Trucking especially. That freight shipment decline. 30 straight months now.
Yeah, the CAS data shows it's been a long, tough stretch for trucking volumes.
You'd think spending would be down too then.
You would, but here's the twist. The CAS Expenditures Index was actually up year over year in July. And the Truckload Line Haul Index, basically, the price per mile excluding fuel, saw its biggest jump since late 2022.
How does that make sense? Less freight, but higher spending.
It's a sign of market rationalization through pain, essentially. Yep. Capacity is contracting. We're seeing bankruptcies, layoffs, like that Pennsylvania trucking company filing or California firms closing after decades.
So fewer trucks on the road.
Exactly. It's a really difficult process. But as that excess capacity gets squeezed out, it starts to stabilize rates for the carriers who are left standing. It's a rebalancing, but a painful one.
With trucking capacity getting squeezed like that, does that create a big opening for rail? Or are they just too different? Especially with this massive proposed merger, Union Pacific and Norfolk Southern potentially creating the first U.S. transcontinental railroad. That's huge.
$85 billion, huge, yeah.
And it seems to have really drawn battle lines, hasn't it? A real split in how people see it.
It absolutely has. It highlights a fundamental disagreement on strategy. On one side, you have shippers groups really worried. They're warning about potentially dismal service and high rates, pointing to problems after past rail mergers.
Their focus is competition, access for customer.
Right. Keep the market diverse.
Yeah.
But then on the other side, you have major players like the Port of Los Angeles, Hub Group. They're fully behind it.
Why?
They argue it'll create a much more efficient single-line network. Smoother cargo flow, no delays switching between rail lines, broader market reach. Their focus is pure efficiency and expanded capability.
So it's efficiency versus competition in a nutshell.
Pretty much. And the outcome of this fight is going to fundamentally shape U.S. freight for decades. It really reflects that deep philosophical divide.
Switching gears to aviation, we've seen some pretty dramatic stuff there too, affecting access and viability. Like the Canadian government stepping in to block that Air Canada flight attendant strike almost immediately.
Yeah, less than 12 hours after it started, stranding something like 130,000 people a day.
That sends a strong signal.
It really does. It basically says air travel is considered an essential public utility, too critical for the economy, for daily life, to allow long disruptions.
Good for supply chain predictability, I guess.
For managers, maybe.
Yeah.
But it effectively takes away the union's main bargaining chip, right? That impacts the power dynamic and potentially the reliability of air travel long term if issues aren't resolved.
And then you look at the low-cost carriers, like Spirit Airlines warning about substantial doubt over its future.
Yeah, they're really struggling, citing weak domestic leisure demand, rising costs. It seems the big legacy airlines have gotten smarter at competing on price.
With those basic economy fares and stuff.
Exactly. They've figured out how to capture budget travelers, kind of eating the low-cost carrier's lunch. Spirit trying to offer more upscale tickets now. It feels like an admission. Their old model just isn't working anymore. A bit desperate, maybe.
And that directly impacts how affordable flying is for a lot of people.
It does. And it's not just airlines. You see big logistics players like FedEx downsizing too. They announced cutting almost 500 jobs, closing facilities. It reflects these broader market shifts hitting employment and overall logistics capacity.
Okay, so let's try and connect these dots. Looking across the whole landscape, what are the big themes tying this all together? One seems to be this massive inventory correction, right, linked to how consumers are behaving.
Absolutely. That freight slowdown we keep talking about, it's not just about people buying less stuff right now. It's fundamentally a correction of that inventory to sales ratio across the supply chain.
The bullwhip effect.
That's a big part of it. Remember, during and after the pandemic, companies massively overordered, anticipating shortages, booming demand.
Right, everyone was scrambling for inventory.
And now, consumer spending has shifted, households are tightening belts, and retailers are suddenly sitting on a mountain, a glut of goods.
Which is why they're not ordering more freight.
Precisely. Why bring more in when the warehouses are full? And that actually explains why third-party logistics companies, 3PLs, are dominating warehouse leasing right now.
Because companies need flexible, short-term space for all that excess stock.
Exactly. It shows that direct link. Consumer behavior, inventory levels, freight demand, or lack thereof. It's fundamental to why transport is so sluggish.
And this sluggish market, it seems to be driving a lot of strategic moves, too. Mergers, acquisitions, a big push on digital transformation.
Yeah, the downturn is definitely accelerating consolidation and realignment. You see stronger companies like Pasha buying GSC's transload business or Torm snapping up those 13 tankers. They're picking up assets, sometimes at a discount, from weaker players.
Positioning themselves for the recovery.
Right. And at the same time, companies are using this relative quiet period, this softer demand, to invest in long-term efficiency. Hiring chief digital officers like at FedEx, boosting AI capabilities, exploring mobility as a service.
It's not just about cutting costs now, it's about getting smarter for the future.
Exactly. Automating, optimizing, improving visibility. It's all about building resilience for the next shock and being ready when demand eventually picks up, making the means of transport more efficient and adaptable.
And overlaying all of this is policy and funding, particularly that strong shift towards a domestic focus we mentioned earlier, really shaping the landscape for national advantage.
Yeah, U.S. federal policy seems very deliberately focused on shoring up domestic transport infrastructure and promoting maybe a more nationalistic view of supply chain resilience.
Responding to the vulnerabilities the pandemic exposed?
Clearly, you see the Department of Transportation announcing millions in grants, innovative finance, ferry services, plus Congress approving big tax breaks for trucking. It's all aimed at making the U.S. supply chain less vulnerable to global shocks, more self-sufficient.
Creating domestic opportunity through stronger domestic infrastructure.
That's the idea. And that controversial Union Pacific-Norfolk Southern Rail merger we talked about, it fits right into that narrative, creating a more efficient domestic network to compete globally.
So looking ahead, what's the strategic outlook? How should people navigate this volatility? Near term, say, through the rest of this year, Q3, Q4, 2025.
The consensus seems to be sluggish but steady. Maybe bumpy is a better word. That artificial import pull forward might be masking some underlying weakness in consumer demand.
So a correction could still be looming.
It's possible, yeah. Labor disputes will likely keep popping up, but as we saw in Canada, governments seem pretty quick to intervene, especially in critical sectors like air travel. That might limit the duration of disruptions.
And trucking.
That capacity correction will continue. Bankruptcies are painful, but they will eventually put a firmer floor under trucking rates as supply shrinks.
So for navigating this, what's the advice for shippers?
Carriers, for shippers, agility seems key. Maybe favor shorter-term contracts right now. Definitely lean on those 3PLs for help managing inventory and finding flexible warehousing. For carriers, it's all about rigorous cost control and maximizing asset utilization, sweating the assets you have.
And investors.
Investors are likely looking at M&A opportunities, betting on technology providers boosting efficiency, and maybe those niche sectors benefiting from specific policies or sanctions, like the compliant tanker market.
And policymakers.
They've got that tricky balancing act. Push for domestic resilience, yes. But don't forget the need for global cooperation, especially on huge challenges like decarbonization, where going it alone just doesn't work.
Okay. And longer-term trends to keep an eye on.
Well, that shift towards a more multipolar, maybe more protectionist world, that feels pretty baked in now. It's going to permanently change traditional trade flows.
Automation and AI.
Absolutely critical. That'll become a core competitive difference maker. The challenge of decarbonizing transport isn't going away either, especially with fragmented global policy that just puts more pressure on private innovation.
And nearshoring.
Definitely. The growing importance of nearshoring, cross-border trade, especially with partners like Mexico, that's going to continue building more regionalized, hopefully more resilient supply chains that fundamentally redefines access and opportunity.
So, as global transportation shifts, as it moves from this idea of one big interconnected web to maybe a series of more fragmented, regionalized, geopolitically shaped lanes, it makes you wonder, how might your daily access to goods, access to jobs, different opportunities, how might that be subtly, but maybe profoundly reshaped by these huge forces playing out in the background over the next few years? What does a more domestic-focused global supply chain really mean for your own economic motion, your own means to get ahead? Something to think about.